Hello everyone. I think the best way for us to learn or go over earnings per share is to just do some examples in Excel so we can see the mechanics of the calculation. So we've got a situation here with company A who currently only in 2021 only has a simple capital structure. So they have net income of $3 million. They have no preferred stock. They have no stock options, no convertible bonds, none of that stuff. Okay, so we're doing this simple. The balance sheet at the end of 2020 shows that they have 1 million shares authorized, 580,000 shares issued, and 80,000 shares in the treasury stock. So at the end of 2020, they have 500,000, 580 minus the 80, shares outstanding. That's how you calculate it. Shares issued minus the shares in the treasury. So that's what we'll start for 2021. Now during 2021, we do two transactions having to do with treasury stock that will affect our number of shares outstanding. We repurchase 50,000 shares on May 1st, and on October 1st, we sell 30,000 shares. We're only worried about the shares, not the amounts, because we're not doing anything in terms of journal entries here in making changes to the equity. And then we have a 2-for-1 stock split that we'll come back to. So if you think about calculating the weighted average, you're looking at each month of the year, and if you were doing this in real life and we were getting really particular, we do it for every day, literally, how many shares are outstanding for the month of January? 500,000, that's what you started with, and nothing changed it until you got to May. So from January through April, it was 500,000. From May to September, it went down to 450 because of the repurchase, and then back up for October, November, December by 30,000 to 480. So if you think of it as you don't have to list all of that out, but that's a good way to think about when the shares and how much is outstanding at each given month. So over here we're going to do the math. We're going to say, okay, the 500,000 shares were outstanding for 4 months. The 450 was for 5 months, and 480 for 3 months. And we multiply the number of shares outstanding by the part of the year. So 4 twelfths, 5 twelfths, and 3 twelfths. Usually that's going to add up to 12 twelfths. We're going to consider every month. But when we do that, we get these numbers here, we add them up, and we get the 474, 167. So you multiply, then add, all right? And you get a total. That's your weighted average shares outstanding without considering the stock split. All right? So we talked briefly last week that stock splits, stock dividends are treated as if they happen at the beginning of a year, even if they happen in December. All right, so in this case, the easiest way to deal with a stock split is just multiply by 2, because it should affect all the shares equally through the whole year. So just multiply by 2. If it was a 3-for-2 stock split, you'd multiply by 1.5. If it was a 30% stock dividend, you'd multiply by 1.3. But it's always the last thing you do to consider that stock dividend or stock split. So that gives us a 948,333 shares weighted average shares outstanding. We take the total net income and we divide by that 948,333, and you get $3.16 as the basic. And we only have to do basic because this is a simple capital structure. Same company rolling forward, but this year in 2022, they sell convertible bonds. Now we have a complex capital structure. These bonds have a 6% interest rate with a conversion factor of 150 shares of common stock for each $1,000 bond, and a total for $2 million. That means we sold 2,000 bonds, each of them $1,000 face value. They now have capital structure. They have net income there for 2022 and the tax rate of 30%. Only one you might say regular transaction similar to what we did in the first year, and that is we repurchased treasury stock once on July 1st, 2022. So, always do basic earnings per share first. So, set aside the convertible bonds for now. Do the basic just like you did in the year number one. So, where do we start? Well, we know that we ended last year with 480. We don't use the weighted average because that's an average. It's not an actual number of shares outstanding. We start with a 480, but we know that there was a 2-for-1 stock split, so it's really twice that. So we start with 960 in the new year. I didn't schedule out each month this time because there's really only one change, but the 960 would be from January through June, 6 months, and then it would go down to 920. And that would be for the last 6 months of the year. So 6/12 both times. Multiply that, add it up, and our weighted average shares outstanding for basic is 940,000 shares. We take our new net income of $3,350,000. We divide it by the 940, and we have our basic earnings per share, just like we did in year one. But unlike year one, we have a dilutive security. We have something that could result in new shares being issued. So we have to look at these convertible bonds. They were available, or they were there for 7/12 of the year. Okay? So we said that there was 2,000 bonds. Okay? And then what we do with convertible securities like this is we pretend that they were converted. So if they would have been converted, that would have resulted in 300,000 new shares. If the whole thing, all $2 million, 2,000 bonds, each for 150. So you see that it's 150 times 2,000 bonds, but that was only around for 7/12. Everything has to be adjusted for the part of the year that is outstanding. We didn't have any convertible bonds prior to June 1st, so we're only going to consider the part of the year after that. So we multiply that by 7/12, and the number that we're going to add to the denominator, the bottom to our shares outstanding, is 175,000. That's the 300,000 times the 7/12. But if we had converted the bonds, we would not have had to pay interest on them for 7/12 of the year. For a whole year's worth of interest, is 6% is 120,000, $70,000 for 7 months. And with interest, we always need to remember to adjust for taxes. The way we do that is just multiply by, if it's a 30% tax rate, by 0.7. If it's a 20% tax rate, it's 0.8. It's always the opposite side of the tax rate. So we multiply that by 0.7, get 49,000. We add that number to the numerator. So we come over here to our fully diluted earnings per share calculation. We take our original net income. We add in the 49,000 of interest we saved after taxes. We then divide that by the 940,000 shares outstanding for basic, plus the new shares that would have been issued because of the convertible bonds, adjusted for the part of the year that they were outstanding. So that's the process if a company has newly added dilutive securities. Now let's go to company B. So this company has from the get-go a complex capital structure. They have stock options outstanding that have been earned and are outstanding. That means that we have to consider them. They can be exercised at a price of $26. That's if somebody uses their option, they can buy the shares of stock regardless of what price they are in the market for 26 bucks. All right. The average price during the company shares was $32. If the exercise price is higher than the average price, we can ignore stock options. That is not the case, or at least the options where that is the case. That isn't the case in this situation. So we're going to need to consider that. All right? But before we deal with diluted, we need to do the basic earnings per share. And so we need to know if there was any changes to the actual shares outstanding. And yes, they repurchased treasury stock twice, May 1st, November 1st, and they bought 10,000 shares each time. So once again, kind of scheduling it out so we can picture this in our mind. From January through April, there was 2.2 million. Okay? And that would have been given to us, okay, in terms of what we started with. It wasn't stated here, but I gave it to you there in the January. And then it went down by 10,000 from May through October, and then another 10,000 for the last 2 months of the year. So each of these amounts multiplied by the part of the year that it applies. Multiply and then add them up, and we get a weighted average shares outstanding of 2,101,667. We take our net income given above, we divide by the shares outstanding, and that gets us $3.88 basic earnings per share. Okay, I misspelled basis. All right. So now it's time to do fully diluted. We never try to do fully diluted until we've done basic. So, for stock options, we are going to pretend as if they have been exercised. If they're exercised, if all of them are exercised, what's going to happen? All of those stock options, the employees that own them, are going to give us $26 to buy shares. So we're going to receive 200,000 times 26, $5.2 million in cash as a company. If that were to happen. Again, we're pretending, okay? So this is a worst case scenario. All the options are exercised. Now, what we're going to assume or pretend is that we took all 5.2 million and we bought back other shares. We didn't just take that money and run. We took that money, it went to the marketplace, and we bought other shares off the marketplace because we knew that now the existing shareholders have to share with more people, and so they would want us to use that money to buy shares back. So we divide the amount of cash we received by the average price of the company's shares, which was $32 in this case. So we would buy $162,500 with that 5.2 million. Each option results in a new share. So what would happen is we would give out 200,000 new shares and buy back 162,500 shares. So the difference is 37,500. That is added to our denominator or our bottom number. So we take the 8.5 million, we divide by the original 2,191,667 plus the difference in the shares from the stock options. Now remember, this actually hasn't happened. We are doing as if it had happened. Okay, so the stock options were not necessarily exercised. We're just looking at the possibility that they could be. All right, moving to the second year. Same as above, except net income is 9 million. Okay, so we're going to carry over the 2,180,000 shares outstanding to start with for the new year. Okay, this year those shares Those options are still floating around, but now the average price of the shares was $35. They repurchased shares both on May 1st and November 1st, and we have an exercise of the option. An exercise of the option means that some of the options were used to buy shares. That means that we're selling to those employees new shares. Okay? So that is going to affect our basic earnings per share. So we really have three things that affect our shares actual shares outstanding. We repurchased on May 1st and November 1st, and the options were exercised on October 1st. So we start with 2180 leftover came forward from last year. Nothing changes until May 1st when it goes down by 20,000. And then we have this stock option exercise. Half of them was 100,000. So shares are going to go up by 100,000. And then they're going to go back down by another 20 when we repurchase 20,000 on November 1st. Each of those is multiplied by the number of months or the part of the year. We get the total and we add it up like we have before. And so that's our basic denominator. We take our net income of 9 million. We divide by the shares, weighted average shares outstanding for basic. Now we can consider the idea of fully diluted and the options and how they impact that fully diluted calculation. So we know that we started the year with 200,000 stock options, but partway through the year, in fact 9 months into the year, 100,000 of them were exercised. So we'd only have, for the last 3 months of the year, only 100,000 options, because those pretend shares became real shares. If we count them in both our calculations, then we will be double counting those shares. So stock options, 200,000 for 9/12, 150,000, 100,000 at 3/12, 25,000. Add those together just like we did we've done multiple times before. We weight it based on the time period that it's outstanding. 175,000 stock options is what we're dealing with, not 200,000 like we did last year. If we exercise those, we would still get the $26. The exercise price doesn't change on options. Once they've been given to the employees, you can't change the exercise. Typically, can't change the exercise price. So $26 times 175,000, we're going to receive $4.55 million in cash. That allows us to buy 130,000 shares back at the new average price of $35 for the new year. So we're going to issue 175, we're going to buy back 130, and the difference is 45. That's added to the denominator. We use our original 2,188,333. We add the 45,000. That becomes the bottom of our calculation. The $9 million stays the same. Okay, on the top, there's no change to that. And we have fully diluted at $4.03. Fully diluted must always be lower than basic. If you ever get a calculation that says fully diluted is higher than basic, either two things happen. You made a mistake in your calculations, or you have a situation where the stock options or the convertible bonds are not dilutive, which means you don't include them. If the fully diluted is higher than basic, you don't use it. Okay, it's always the worst case scenario, the lowest possible scenario for a fully diluted. Which reminds us that if it's a loss, okay, we don't do it, because if you had fully diluted loss, it would be lower, it would be less of a loss, and that would actually be better. On the negative side, less is better than more.